The world's most indebted superpower is seemingly cornering its closest ally, and the stakes couldn't be higher. Is the US demanding Japan wreck its own economy or face the consequences? This isn't a conspiracy theory, it's a potential glimpse into US foreign policy in 2025, and the implications are staggering. Buckle up, because this isn't just another trade dispute, it's a potential global financial shift that could reshape markets, alliances, and the future of the dollar itself. Japan is facing a confluence of economic headwinds. Toyota's staggering losses. The automotive giant has already lost a reported $1.3 billion. GDP in freefall. The Japanese economy is already contracting. U.S. demands for rate hikes. Washington is pressuring Tokyo to raise interest rates, a move that could detonate Japan's entire bond market. Why this pressure? The U.S. is struggling to maintain its trade position and needs to unload a massive amount of debt. Essentially, Washington is trying to save itself by pushing Tokyo to sacrifice its export advantage. The U.S. Treasury's latest report explicitly calls on the Bank of Japan to tighten policy and reverse yen weakness, even though Japan is already teetering on the edge of recession. With Japan's debt-to-GDP ratio already at a staggering 261.3%, the highest in the developed world, these demands feel less like diplomacy and more like economic blackmail. But here's the twist: Tokyo isn't backing down. Instead of folding, Japan is exploring real leverage and preparing a countermove Washington didn't expect. Opening the CPTPP to China and Taiwan, Japan is considering opening up the CPTPP trade bloc to both China and Taiwan, a direct challenge to U.S. dominance in Pacific trade. This is a strategic pivot, not just a tariff negotiation. The U.S. faces its own challenges. There's an upcoming 30-year, $22 billion bond sale that's really going to test whether global markets still believe in U.S. solvency. Lately, domestic buyers have actually slashed their participation in bond auctions, which is, well, a bit concerning. On top of that, the U.S. deficit is projected to balloon by trillions, mostly due to all these stimulus plans. So, investors are being asked to lock in yields even as the deficit just keeps growing. If foreign demand collapses, especially from Japan, which is, one of the largest holders of U.S. debt, the fallout won't just be regional, it'll be global. A failed Treasury auction would send a pretty clear signal that Washington's debt-driven model is no longer credible. The U.S. Treasury has explicitly instructed the Bank of Japan to tighten monetary policy to force yen appreciation. But BOJ Governor Kazuo isn't playing along, warning that household consumption is already deteriorating. In Japan, inflation is being driven by fuel and food costs, not by overheating demand. According to Deutsche Bank, Japan would need a massive yen appreciation to meet U.S. trade balance goals, and honestly, that would devastate Japanese exporters. Japan is moving fast to insulate itself from U.S. volatility by expanding across CPTPP markets. Exports to CPTPP countries are surging, and companies are ramping up capacity in other countries to sidestep U.S. tariffs and rewire supply chains. Tokyo isn't begging for relief, it's building an exit ramp. Global sentiment toward U.S. long-dated debt is really collapsing. Traders are actually calling it a silent boycott by foreign institutions. Japanese pension funds, for example, are shifting into euro-denominated infrastructure bonds just to escape the volatility of the U.S. dollar. Inflation expectations are climbing, and that's, signaling a pretty serious trust issue in U.S. fiscal management. Washington wants to reshore production and reduce reliance on global supply chains, but still depends on foreign capital to fund its debt. This is, honestly, an economic paradox. You just can't bring everything home and keep the dollar strong unless global investors keep buying your debt. Japan is now drafting contingency plans to admit Taiwan into the CPTPP, which would, redraw regional trade routes and provoke backlash from both Beijing and Washington. Japan is signaling it won't just serve as a passive outpost for U.S. monetary ambitions anymore. If the U.S. insists that yen appreciation is non-negotiable, this could really escalate beyond tariffs, rates, or deficits. The real question is what Japan is willing to risk to reclaim its economic independence. What if Japan doesn't just reject U.S. pressure but actually starts rewriting the global trading system from the inside out? If America loses Japan as a financial co-anchor in Asia, the fallout won't stop at rising bond yields. It could fracture alliances, redirect capital flows, and even redefine how global trust is priced. The ultimate question is this: if Japan walks, who replaces it, and what if, no one can? What do you think? Will Japan stand its ground, or will the U.S. force its hand? Share your thoughts in the comments below.